It's September 2025. With the Federal Reserve's interest rate cut cycle underway, the gold and silver markets are booming again. Gold reaching $4,000 an ounce this year is no longer a dream. Faced with the unstoppable trend of shorting fiat currencies and going long on hard assets, while focusing on gold and silver, we also need to explore other major hard asset targets and identify promising opportunities within these lists. This issue provides strategic investors and portfolio managers seeking superior returns during the inflation and commodity supercycle with an in-depth analysis of U.S.-listed critical mineral companies. The report's core argument is that the U.S. is addressing its over $37 trillion national debt through massive private sector capital expenditures, particularly in the construction of AI data centers and power infrastructure. This strategic shift is fueling an unprecedented wave of mineral demand. This macroeconomic shift is not accidental. It is driven by clear policies aimed at stimulating productivity growth and ensuring national security. The analysis shows that the government is actively supporting the domestic mining and processing of critical minerals through funding, regulatory reforms, and expedited approvals. The report comprehensively examines 5 key mineral categories, excluding lithium and rare earths, copper, uranium, nickel, phosphates, potash, and molybdenum and cobalt. It analyzes the market dynamics within each category and highlights over 20 companies operating within the United States that are poised to significantly benefit from these policy and market trends. Some of these companies are large, diversified industry giants offering stable market exposure. Others are high-growth, high-risk junior miners whose value is driven by key project milestones and strategic partnerships. This report provides an in-depth analysis of how these companies are uniquely positioned to capitalize on the coming infrastructure boom, offering investors a comprehensive, actionable investment framework. In recent years, concerns have been mounting about the soaring U.S. national debt. With the total debt exceeding $37 trillion, interest payments have even surpassed defense spending, sparking widespread discussion of a debt apocalypse. Despite warnings from leading institutions such as Yale University, Wharton School, and the Congressional Budget Office (CBO), the austerity measures proposed by mainstream doomsday theorists, such as spending cuts, are generally politically unfeasible and could lead to a severe economic recession. This report's macroeconomic foundation rests on a distinct narrative that the United States can growth solve its debt problem, as it did after World War II, by boosting productivity and gross domestic product, GDP. Central to this solution lies massive private sector capital investment and the construction of artificial intelligence, AI, data centers, and supporting power grids is the perfect vehicle for this wave of investment. AI models and cloud platforms require massive data centers as the backbone of the digital economy. These data centers are not simple server rooms, but industrial complexes worth over $1 trillion. McKinsey & Company predicts that global data center investment will reach $7 trillion by 2030, with over 40% of that investment occurring in the United States. Furthermore, NVIDIA's quarterly report predicts that tech giants like Apple, Meta, Microsoft, and Google will spend approximately $1 trillion annually on data center capital expenditures by 2030. However, data centers cannot operate without electricity. The U.S. Department of Energy predicts that electricity consumption by U.S. data centers could double or triple by 2028. To meet this demand, the Edison Electric Institute, EI, indicates that U.S. private utilities will invest over $1.1 trillion in grid infrastructure between 2025 and 2029. This massive capital expenditure has a significant multiplier effect. The American Society of Civil Engineers, ASC, estimates that every $1 billion in infrastructure investment creates 13,000 jobs and adds $3 billion to GDP over a decade. If the $5 trillion in investment in AI data centers and power generation by 2030 materializes, the U.S. economy could see an additional $15 trillion in growth. This ambitious vision is not without risks. Studies have shown that a lack of regulation or planning could lead to higher electricity prices and erode industrial competitiveness. Furthermore, given the land, water, and energy requirements of these projects, local community opposition, lengthy permitting processes, and regulatory hurdles remain significant challenges. However, these challenges are precisely the driving force behind active government intervention. Public policies must streamline permitting processes, promote public-private partnerships, and support the diversification of energy generation. The critical demands of low latency and reliable electricity for AI highlight the strategic importance of nuclear energy and advanced energy storage technologies, creating direct, policy-driven investment opportunities for related minerals. Let's examine the key minerals identified by 4 major industry drivers. The first driver is AI data centers. These projects involve the construction of chip manufacturing, servers, cooling systems, large-scale computing facilities, and other facilities. Key minerals required include copper, nickel, aluminum, and silicon, which will drive a surge in demand for electronics and infrastructure materials. The second driver is grid modernization and expansion. These projects include the construction of new substations, transmission lines, and power plants, as well as energy diversification. Key minerals involved include copper, uranium, nickel, and zinc. Large-scale electric power deployment will lead to a surge in copper demand. Nuclear energy, uranium, enjoys policy support due to its stability and reliability. The third driver is electric vehicles and energy storage. These projects include battery production, charging infrastructure, and large-scale grid storage. Key minerals required include cobalt, nickel, copper, and graphite. This will lead to continued strong demand for key battery minerals, making supply chain security a primary concern. The fourth driver comes from traditional industry and agriculture, which provide investment hedges against inflation and global food security. These projects require large quantities of steel, fertilizers, and industrial chemicals, and also generate significant demand for molybdenum, phosphates, and potash. To address supply chain vulnerabilities, the U.S. government has identified a list of minerals critical to the national economy and security. Based on the 2022 final list of critical minerals released by the U.S. Geological Survey, USGS, we focus on categories such as copper, cobalt, nickel, molybdenum, uranium, vanadium, phosphates, and potash. The U.S. Department of Energy, DOE, is implementing a multi-pronged strategy to ensure the security of the domestic critical mineral supply chain. This strategy includes funding opportunities totaling nearly $1 billion, with several key projects worth noting. First, the Critical Minerals and Materials Accelerator, allocating up to $50 million to accelerate the maturation of refining and alloying technologies, such as gallium, germanium, and silicon carbide. Second, the Mine and Metals Capacity Expansion Program, allocating approximately $250 million to fund the recovery of valuable byproduct critical minerals from existing industrial processes, including coal-based industries. This suggests the government is encouraging a more circular supply chain model, sourcing minerals through recycling rather than traditional mining. Next, the Battery Materials Processing and Manufacturing Grant. Grants of up to $500 million will be allocated to expand U.S. capacity in critical mineral processing and battery manufacturing and recycling. This program supports facilities processing traditional battery minerals such as lithium, graphite, nickel, copper, and aluminum. These government initiatives are important not only for providing funding, but also for reducing the technical and financial risks of domestic projects through direct policy support. They create a distinct competitive advantage for companies aligned with government strategic objectives, enabling them to more quickly transform resources into viable commercial projects. Therefore, companies participating in these government-funded programs or with projects aligned with emerging strategies, such as byproduct recovery and unconventional resources, are particularly noteworthy. We will share information on some of these relevant companies in the next issue.